Hey guys, James here, and welcome to the next installment on my channel here at Forex Journey with James. Now, if you've watched all my previous videos up to date, you'll know that we've covered everything from the beginning stages of the charting software. So learning how to sign up to tradingview.com and how to format our charts and set up the tools so that we're ready to be able to set ourselves up when it comes to trading. Now, the next logical step is to move on to actually explaining what it is we're looking at. So that's what I'm going to be diving into today. And we're going to take this away on the whiteboard, as you can see behind me here. So we're just going to go into the actual Forex fundamentals, if you will. So the basics of exactly what we're looking at. We've got our charts set up ready. We know the tools that we're going to be using. So now we just need to understand what it is we're exactly looking at. So as explained in previous videos, when we've been actually looking at the charts on TradingView, we've been looking at the currency pair Euro US dollar, which is what we can see. So when you get into Forex trading, essentially we are trading currencies. Now, how we trade those currencies is by pairing two currencies together and profiting on the difference between the two when we're either buying or we're selling of the currency, which I'll go deeper into in this lesson as well. But just for the basics, essentially you have the different major currency pairs, and when you piece two of them together, that then forms a currency pair, and it's the currency pairs that you then trade. So essentially here we have two currencies. We have the euro and we have the US dollar. So this first part here, the euro, represents what's known as the base currency, and the second currency represents the quote currency. Now, when you look at the charts, so you see all of the charts doing what it's doing, you have two axes along your chart. So what we have is on the bottom axis we have time, and on the side axis you'll have price. So when you look at the side and you see all of the different numbers that you can see along the sides, this is essentially giving you the quote, the quoting price. So if you look at Euro US dollar and you see that the price on the side of the screen is showing that price is at currently 1.12, then that is essentially meaning that it would cost $1.12 to buy €1. I'm just going to clear this off and move on to the next point. What are the major currency pairs that most people will look to trade on? There's actually 8 major currencies that can be combined together to form 28 different pairs that you can be able to trade on. Now, realistically, you only need one of those. If you do want to add more later on down the line, that's absolutely fine, but you should only ever start with one. But the major currency pairs that you can look at to form a currency pair are as follows: Euro, US dollar, Japanese yen, Canadian dollar, the Australian dollar, New Zealand dollar, pound, last but not least, the Swiss franc. So each of those, if you were to write the same across the top, you can now take each of these and you can combine the two. So you would have the euro versus the dollar would be one pair, the euro Japanese yen, the euro Canadian dollar, so on and so forth. This would give you then 28 different pairs that you would be able to trade from. Combine any two of them and you'll be able to put them together. So you could have euro pound, you could have Swiss Japanese yen, Australian dollar, US dollar, pound, Australian dollar. You can combine them in multiple different ways, but you pick any of the two, match them together, and that would be a pair. And the most commonly traded one is the euro US dollar. It's the one pair that I trade on and what I will use for the basis of all of the videos. So at this point, we know what the base and the quote is when forming a pair. We know the 8 major currency pairs that we can combine to make 28 different pairs that we can trade. Now we're going to talk about how we measure the movements in price. So you may have heard the term a pip. You may have heard the term ticks. In terms of these, more often than not, you will use the term pip. And this essentially, so you have a pip or ticks. So a pip is essentially a percentage in point. Excuse my messy writing, I am a lefty. I'll try and make it as clear as I can. Now, how do we use this? So when you look at a Forex chart, so when you look at a pair that you may be trading, you see the quote price on the right hand side, on the right hand axis. Now, what you will see typically is you will see, for example, for the euro US dollar, you might see the price denoted as 1.12, like so. So you will see the price denoted like this. So most currency pairs will show you the price up to 5 decimal places. There is an exception to that for anything that is yen based. So for example, the Japanese yen will usually be denoted, so maybe 110, but it's denoted usually using only 4 decimal places. Tick, which is the smallest unit of measurement possible, would be this end figure here. A pip would be this unit here. So if on this, for example, price moved from 1.12 and the price went up to 1.1201, then we know that price has moved up by 1 pip. With the Japanese yen, so using that as an example, if price had gone up from that to 110.001, then that again has moved up by 1 pip. Okay, so now we know what a pip is and how we measure the movements in price on a particular Forex pair. I'm going to go into some examples of what actually happens when we look to buy or sell a currency, because you can profit from the markets whether price is going up or whether price is going down, and essentially what the differences of those are. But I'm going to go into a little bit deeper, just a few fundamentals of what happens when we execute a trade, just so you're aware, because the figures, to those that are unfamiliar with Forex, it might sound a little bit scary with some of the numbers that I am going to put out, but it is going to make sense as to what happens. But essentially, when we execute a trade through a broker, we are using leverage to be able to purchase more of the currency that we actually hold in our accounts. The reason for that is because the change in price is at such a low rate, you're talking down to the 5th decimal place, that we're trading on the minute changes in price. So therefore we have to do this at scale to be able to make any sort of profit and good money from the markets. So with that being said, so the way that we look at placing a trade through a broker is essentially we're trading a certain amount of lots, is what they refer to. So lots, one lot is the equivalent of 100,000 of the base currency. So if, for example, we're talking about the euro US dollar, then this would essentially be 100,000 euros. Now, most Forex brokers will allow you to trade with micro lots. So instead of having one full lot, you could trade on 0.01 lots, which would be the equivalent of, again, using the euro, this would be the equivalent of buying or selling 1,000 euros. To break that down, to make it help you to understand more. So if you're buying 1,000 euros worth of price, it roughly means that for every pip that price changes, it essentially is going to mean a change of around 10 cents. Yes, I did state that in dollars. So in pound, it's going to be around 7p, roughly. So this is where, if you're buying 1,000 euros and price changes by 1 pip, you've made 7 pence. Not a lot at all, but that's where it is. Likewise, obviously, if you're trading on a 0.1, that then means that the equivalent amount that you're buying or selling is actually 10,000 euros, which converted is going to mean that you'll be earning $1 per pip, or 70p, and so on and so forth. We work through. So the way that it works in trading is that you're essentially trading on leverage from the amount that you have in your accounts. So say, for example, and you've seen through my YouTube videos so far as well, that I've started a public account that I share with you all. You can all see the current balance, the wins and losses, and I started that with £1,000 in it. Now, the broker that I use, they offer me leverage. Now, most brokers in Europe, they have to follow strict regulations, and especially for us as retail traders, the maximum leverage that they can give you is a 1 to, or 30 to 1. That means that for every pound you have in there, the broker will allow you to buy or sell up to 30 times the value that's in your account. So it essentially means, when I started with the £1,000 in the account, it essentially means that I have buying power available of up to 30,000. So where does that put me? That puts me, so total would be essentially 0.3 lots that I would be able to essentially trade on with that. Now, some brokers do offer a lot different leverage, and with some of them you can get up to 500 to 1 leverage, and especially with professional accounts and things as well, you can get up to 500 to 1, which is obviously going to mean that instead of having 30,000 available, you would have essentially 500,000, half a mil available. So, which would be the equivalent of, what's that, 5 lots at any one given time. Now, of course, there is margin requirements as to how much you can actually purchase in a position, but this is where we start looking at the calculations, because essentially from our balance, we only ever want to risk a maximum of 1%, especially whilst you're early in the beginning stages. Obviously later down the line, there are other ways that you may want to look at increasing your risk, but usually the general rule of thumb is that you always want to stick to a 1% risk. So it means that on a £1,000 account, the maximum you want to risk is going to be £10 on any one trade. Obviously, as the balance increases or decreases, that amount is going to change, but let's just say for argument's sake, we've got exactly £1,000 in there. So it means that we only want to risk maximum of £10 in a position. So this is where the calculations start to come into effect, because on a 0.01 lot, we're essentially risking 7p per pip. So it means that we need to figure out where we're buying and where our stop is going to be, which this I will explain down the line. But this essentially is what you'll need to kind of remember in future, and I will dive into it again as well in the future. But just for when it comes to working out our risk and how much we want to buy or sell of a certain instrument, this is just what I wanted to go into, just to make sense for the examples that I'm about to give, which will go into what actually happens when you buy or sell a currency. I needed to give you this, I felt that I needed to give you this explanation first so that you can understand that the figures that I'm about to say isn't as bad as what it may seem to someone that's not been involved in Forex or understands what's going on in Forex. So the figures that I'm about to use, for example, are going to refer to buying 10,000 euros or selling 10,000 euros. And I don't want you to panic at that figure if you're new to Forex, because essentially that just means that for every pip that price is moving, it's going to increase or decrease the account by $1 or 70p essentially. So yeah, that covers that. I'll come into the examples in just a moment. Okay, so I'm now going to look at going into what actually happens when you're looking to either buy or sell the currency that you're looking at on the charts. So we're going to use big round figures just to keep the calculations nice and simple for the sake of this video. And so in this example, I'm going to go through the opportunities for the euro US dollar and what actually happens. So first example we're going to go into is a buy example. So you're looking at the charts and you see an opportunity that you now want to buy the currency with the expectation that price is going up. So essentially you're buying low and you're selling at a higher price, because you have to do the opposite of the initial action to get out of the particular trade. So if you buy into the market, you of course need to sell it at a higher price to realize the profit. So let's have a look at this example here. So say for example, the quoting price is at 1.12. And again, like I say, I'm just using round figures just to keep it nice and easy. So with this example, you've calculated out your risk and you're going to be essentially buying 10,000 euros at this price. So what does that mean? So essentially, as we discussed earlier in this video, so this is the quoting cost. So it essentially means that in order for us to buy 10,000 euros, it's going to be the 10,000 times by the 1.12, which means it's going to cost us $12,000 to be able to purchase 10,000 euros. Now, this is exactly what happens when you click on the buy button and it'll calculate it out. This is what you need, well, this is where you'll calculate out. So in your broker, essentially you'd be buying 0.1 of a lot at this point. This is what goes on behind the scenes. Essentially it costs you $12,000 to buy 10,000 euros remembering from the earlier explanation that this just means that for every pip that price moves, that's going to equate to $1. Now, let's say you purchase at this price, and price then moves up and shoots all the way up to 1.13. So as we've bought down here, we now come to sell out here at the higher price to realize the profit from where we've purchased at a lower price. So what happens here? Well, we've bought 10,000 euros at this stage. So here is where we're going to now sell the 10,000 euros. But our quote is now at 1.13. So it means that this is now going to equate to $13,000. So essentially, we bought, it cost us $12,000 to purchase, and we've now sold it back to the market for $13,000. So it means that the difference there is $1,000. And that is where you make your profit on the buy in this example. Now, just to kind of explain, so we can see here its price has gone from 1.12 to 1.13, which is representative of 1,000 pip move, which isn't going to happen overnight. That would obviously take quite some time to realize that kind of a move on the markets. Typically speaking, with FTR and how we trade, you could be looking at anywhere from sort of 20 to 100 pip move that you'd be looking at. So typically you wouldn't be reaching for this size of a move unless you were looking at more of a longer term approach and swing trading, for example. But this is just indicative of a 1,000 pip move, just using round figures to make the calculations nice and simple. Just going to clean the board again, and we'll go into the sell version of this. Okay, so we're now going to look at a sell example. So you decide when looking at your charts that you've identified an area that you're now looking to short from. So you think that the price is going to depreciate in value. So essentially what happens in this is it's kind of similar to the buying position, except it's the reverse of that. But in terms of what happens at your broker and when you're executing the trade, I'm just going to go into this here. So let's say, for example, the quote, and I'm going to use the same figures just to make it nice and easy. So the current price, the current quote price is at 1.13, and again you're looking at obtaining 10,000 euros. So with respect to that, what happens is the broker that you're executing the trade through, they loan you the 10,000 euros, which is then executed and sold to the other market participants, and you're then in the position. So again, 1.13 times by the 10,000 euros, so that's on loan from your broker. They loan it to you, which means that you obtain essentially 13,000 US dollars for this. Now, with this loan, obviously once price goes down in value or goes up in value and you're losing money, because essentially what happens to get out of this trade, we've now sold it to the market, but we essentially owe the broker the 10,000 euros back. So we have to buy the euros back at a later point. So essentially we want price to decrease in value so that it's cheaper for us to buy the euros back and we profit on the difference. So let's say that's exactly what happens. Price depreciates in value and now gives you a quote of 1.12. So essentially we want to buy back the 10,000 euros, which at a quote of 1.12 is going to cost us $12,000. So again, we then capitalize or realize the profit of $1,000. Remember, we received 13,000 at the point that we sold to the market. We then bought it back from the market at a lower price, but it's only cost us 12,000 to do so. We therefore then profit on the difference of 1,000. And again, going from 1.13 down to 1.12 again is a 1,000 pip move. That about covers it for this video. As I say, just going into the fundamentals. So if you followed along with this video, you'll now be able to understand that we know what it is that we're actually trading, so the currencies that we're using, how to connect those as a currency pair. Using the top 8 major currencies, we can then form 28 currency pairs from that. Now, you're not going to be trading on all 28 pairs. I mean, you can do, but there's not always going to be a need for that, especially if you're new to Forex as well. You only want to pick one pair at a time, learn how to understand how the pair moves and master that pair and develop a consistency and profitability on that one pair before even considering adding another currency pair. The more pairs you add, the more distracted you're going to be, and ultimately it's going to cost you in the long run for doing that. So always work on one pair at a time, master that before looking at adding anything else. So we understand what it is that we're looking at on a chart in terms of how we're measuring the price movements using the base and the quote currency pair. We know what a pip and a tick is, which is all just us using the pips as a way of measuring the small units, the small standardized units of price. And we know from there what's actually happening behind the scenes with your broker when you actually buy or sell into the markets, as we essentially can make money from the markets whether price is going up or whether price is going down. And so with that, I've given you a few examples as well, just showing you what happens when you actually buy a position and when you sell a position as well, and what's actually going on in the back end in terms of how we actually make our money from the Forex markets. So I hope you enjoyed. I hope my writing is legible. I'm about to find out very shortly. And if you did like this style of video, it is a little bit different to what I normally do, with it being usually on the laptop and on the charts. But if you did like this style of video, please just drop a comment below and let me know. And I'll see if there's more videos in the future that I'll be able to do using this as well, because I think it is good for breaking down different topics as well. Sometimes it's great to be on the charts and break them down, but sometimes drawing and explanations can really help kind of accelerate that growth as well. But if you did enjoy, please do like, subscribe and follow. Really just helps me try and grow this channel as well, so that I can give more and more back to you guys as well. Really hope you enjoyed this one, and until the next one, take care. Thank you.